The stock market can help you earn a ton of money. But if you're tempted to invest randomly without knowing the ins and outs of the market, you risk losing everything. So make sure to watch this video before investing in the stock market. Risk and reward are the first two elements that will define your level of success in any investment endeavor. Your objective should always be to lower the risk and raise the potential profit. However, before doing this, you must be aware of both the risks and the potential rewards. The risk element exposes you to the prospect of financial loss. No new investor wants to hear about losing money. If you know the risks and how to manage them, then you'll be ready to take advantage of them. Today, we'll be talking about the stock market, and we can guarantee that this is one ride you wouldn't want to miss. But before that, make sure to like and subscribe to the Inlet Financial Coaching channel. Now let's get started. What exactly is the stock market? The collection of markets and the exchanges where activities such as the buying, selling, and issuance of shares of publicly owned companies take place is referred to as the stock market. The formal exchanges or over-the-counter marketplaces are used for these financial transactions. A specified set of guidelines must be followed for these transactions. A country may have several venues for stock trading. Transactions in stocks and other types of securities are permitted at these venues. As long as everyone engaged follows the rules, then everything will be fine. Although the term stock market and stock exchange are sometimes used synonymously, a stock exchange is actually a subset of a stock market. Please don't get confused by these terms. We'll make things easier for you since a lot of people make this seem complicated when it's actually not. Let's say you're an investment enthusiast. If you trade in the stock market, this simply means that you purchase equities and shares on one or more exchanges. A whole stock market is made up of these exchanges. Different countries have different stock exchanges. Stock markets, to put it simply, are open spaces where individuals gather to purchase and sell shares. However, the development of technology has allowed for these exchanges to currently function as electronic marketplaces. A financial instrument that denotes ownership in a particular company is known as a stock or share. A shareholder who owns shares in a company is entitled to a residual income from the company's profits. Dividends are what are paid out on a quarterly, biannual, or annual basis. The right to vote at corporate meetings is frequently granted to stockholders. Owning stock in a company entitles you to a stake in it. If the company decides to disband today, the amount of money or assets you would receive would immediately correspond to the stake you held in the company. Let's travel back in time. Trading of equity shares was made possible by the establishment of the New York Stock Exchange, or NYSE, in 1792. Together, 24 stockbrokers and merchants from New York City signed the so-called Buttonwood Agreement. Up until recently, Wall Street brokers and traders would gather there to buy and sell shares. These earlier gatherings and transactions were not legitimately authorized and regulated. Regulation and professionalism in the stock market were brought about by further advancements in civilization. Over time, there were numerous stock exchanges both in the United States and around the globe. Technology has advanced even further today, moving trading away from these centers and onto the internet. Since some of the exchanges are connected electronically, traders can conduct business in a structured manner while sitting in their homes. In the past, there was an insider's advantage, but today's stock market is more efficient and liquid. For the most part, at least, there's an even playing field for all participants. Let's move on to the stock market supply and demand. Although there are other methods for determining share prices on a stock market, the auctioning procedure appears to be the most popular. Bids and offers are placed throughout this procedure by both buyers and sellers. This refers to the amount an individual is willing to pay for the stock offer and the price an individual is willing to sell. Ask is another term for this. A transaction can only occur if the bidder and the individual asking both agree on the price. There are thousands of deals taking place at once, which causes fluctuations in share prices. A stock exchange serves as a platform for connecting these people who intend to sell and investors who are interested to purchase. You will require a broker's services if you want access to these exchanges. The broker serves as the middleman and stands between the seller and the buyer. Surprisingly, the brokerage has evolved from registering with individual brokers in their offices to setting an account with an online retail broker. Every economic system has relied heavily on the law of demand and supply. In a system where millions of people are trading simultaneously, it becomes even more clear. This is how real-time stock trading applies the law of supply and demand. The price of a stock will increase when more investors express interest in those particular stocks. On the contrary, the price drops when more stockholders seek to sell their shares in a company. A trade may only take place if both the buyer and the seller agree to the price being asked for or being bid on. What actually happens when there are more buyers than sellers? The buyers will be open to increasing their bidding price. Let's put it this way. If there are more sellers than buyers, the buyers will drop their bids, and the sellers will accept them. So the laws of supply and demand affect how much a stock is worth. These are the things you shouldn't do when it comes to stock investing. 1. Avoid investing randomly. Gambling is the same as purchasing shares of a random company. This is something that some people do. As crazy as it may sound, they simply do it to feel like they're investing while in reality, they're just playing with their money. You ought to put money into a company that has demonstrated measurable growth. You need to research the management's history and their internal practices. Some companies' management may have a history of legal disputes and cut corners. These people may even be deceitful and have taken advantage of the company by keeping some profits for themselves. The majority of the risks might have been kept from investors. You're risking a lot of money if you invest in such a company. Make sure you know the company's history and records before purchasing any of its stock. Be persuaded that the company has the potential to increase in value over time. Keep in mind that you should invest to grow your money, not waste it. 2. Don't get too emotionally invested. You must refrain from making an investment in a company just because you particularly like it. It can be risky when consumers purchase stocks in a company on the stock market only because they like the company or because of the interesting stories they've heard about it. Another issue can be selling too soon out of excitement or when minor changes occur. If you want to win this game, simply leave your emotions at the door. What actions should you do to maximize the return on your stock investment? First, think long-term when investing. If you want to make long-term investments, you must be willing to hang on to your stock for at least 10 years. If you're racing for earnings, you risk falling into the emotional trap. In stock investing and other forms of investing, these two emotions lead to losses for investors. The main reasons for investing money losses have been shown to be greed and fear. When a stock starts to decline, a scared person wants to sell. A person who's greedy wants to buy when the stock price is rising. Stocks change frequently and indexes rise and fall, but if you've chosen well, your money will be secure over the long term. Regardless of how many fluctuations there are along the way, a long-term investment will produce excellent results. Next, spread out your investment. You should distribute your money throughout the several stock market tiers. There are listed companies from small to medium and large. You must have thoroughly researched each of the firms you want to invest in. This will aid you in navigating market turbulence. Some shares will perform well, while others might not. Don't put all of your eggs in one basket. Diversifying your portfolio will give you enough protection to know that regardless of what happens, at least your investment will grow steadily. That concludes today's video, which we hope you enjoyed and learned something from. If you liked this video, don't forget to give it a thumbs up and subscribe to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.